Good afternoon, everybody. My name is Tom Olivers, and I'm your NCOIL president, and you are at the NCOIL-NAIC dialogue session. And before we get started, I would just like to acknowledge and thank our representatives from the NAIC who have joined us today. We have Indiana Director Amy Beard. We have Kansas Commissioner Vicki Schmidt. We have Oklahoma Commissioner Glenn Mulready. We have Pennsylvania Commissioner Mike Humphreys. We have Tennessee Commissioner Carter Lawrence. Thank you for being such a gracious host, my friend. We're loving your city. Utah Commissioner John Pike. Wisconsin Commissioner Nathan Hodick. All right. Well, thank you all so much for...
You introduced him, right? Yeah.
Everybody, didn't I?
Yeah, I thought.
Did I miss anybody?
Yeah.
I did?
Oh, Tim Temple
Oh.
from Louisiana.
And Commissioner Tim Temple from Louisiana. I'm so sorry. All right. You're not on my list, but you're on my list now. All right, we're not going to have a roll call for this meeting. We'll just mark everyone's attendance. I'd like a motion to waive the quorum requirement. Got a motion? I'm going to have a second. All right, so moved. Voice vote. All in favor of the motion to waive the quorum requirement, please say aye. Aye. Great. Anyone opposed? I'd like a motion to approve the November 17th, 2023 committee meeting minutes. Got a motion? Can I have a second? Second. All those in favor, please say aye. Aye. All right. Any opposed? Very good. Before we get started, I'd just like to say that I really appreciate our commissioners for joining us. One of the really important things to me, not just as NCOIL president, but just as a member of NCOIL, is the very close relationship that we have consciously worked very hard over the last many years to develop between our regulators and our legislators. We can't do what we do without you all. And you need us as well, so we're grateful to partner with you. And so we're grateful that you're here as we work together on these issues. Let's see, I have done introductions. And so let's see. Last month, NAIC concluded its spring meeting in Phoenix. And myself, Representative Lehman, and Representative Dunnigan were privileged to be able to join you all at that meeting, where we had a very nice discussion about several issues. So normally the spring meeting for us precedes your meeting, but since we're doing it in reverse now because we're having ours in April, we thought that it might be a good idea to begin the dialogue by discussing sort of a quick recap of what happened, the highlights at the spring meeting. So I will sort of open that up to whoever wants to comment on that, if you want to just give us a brief recap of what was discussed in Phoenix.
Thank you, Mr. President. Before we even get there, if I can, I'll just echo your comments. The effort that's been put in and the progress that's been made with NAIC and NCOIL, I think you need no more proof than that than to see you've got 7 regulators here at this meeting, and I don't know how many, but probably about a dozen staff as well from our departments are at this meeting. So that speaks volumes, I think, on the progress that has been made. And I speak especially to the new members who are here for the first time. I previously was a legislative member and I was very engaged with NCOIL and the great work that they do here. I will kind of kick it off here, but then we've got folks lined up to hit on the different topics. As you mentioned, last month we had our meeting in Phoenix. We had 2,300 attendees for that meeting. We did have a great breakfast with the NCOIL officers and the NAIC officers. Those are just so helpful for those that aren't officers, but just that small group, really helpful conversations that take place there. I'll start out with, as most of you know, many of you know, that April 30th of 2023, Tom Considine's long-lost cousin, Mike Considine, resigned from the NAIC. And at the meeting in Phoenix, we announced the designation of the new CEO, which is Gary Anderson, currently the commissioner for the state of Massachusetts. Gary's a a friend of all of us on here, and I think very uniquely qualified. He served in staff at the Massachusetts Senate. He's an attorney. He has served as a commissioner under Republican and Democrat governors in the Great Bay State. And he also has chaired our international committee, so has his head and hands around the international space better than anyone at the NEIC. So he will begin actually on May 1st in that role, though that was announced in Phoenix. And I know we are very much looking forward to that. One other thing I might add, it wasn't announced there, but just sort of some late breaking news in the NEIC world. Illinois Commissioner Dana Severinghouse has resigned, and the governor there appointed Ann Gillespie, who will actually begin on Monday. So she is just starting as a new commissioner in the state of Illinois. And I've not met Ann yet. She was just named, but she has quite a background in healthcare. Retired healthcare executive, was elected to the Senate 6 years ago in a northwest suburb of Chicago in Arlington Heights. So we're looking forward to meeting her and welcoming her there. So that is sort of the quick snapshot of the NEIC. I will now toss it over to the Commissioner from Pennsylvania, who will talk about some of the regulatory priorities that we're working on.
Thank you, Commissioner. Mike Humphreys, glad to be back. As some of you know, I was your Director of State Federal Relations 15 plus years ago, at a time when Dodd-Frank was popular, fights about the optional federal charter were popular, and of course the Affordable Care Act went through. So I'm glad to be joining you again and appreciate the opportunity to share the table. So as part of the beginning part of every year, the NEIC will get together and we'll discuss what our priorities are going to be for that year. You heard President Andy Mays roll them out largely at the spring meeting. I will talk about them again today. Not a lot of surprises. As you all know, a lot of our insurance issues have longer tails, and they're issues that carry over from year to year. So we have 5 key priorities that we're focusing on this year. The first being our continued work on climate risks, natural catastrophes, and resilience. I know later in this agenda we'll talk about one of the issue areas within that bucket, and that's data collection and the data call that we are working on independently, but we'll collaborate with FIO on. We're also looking towards advocating for mitigation funding. I think that's another issue on your agenda, and you're going to hear from Alabama and its Safer Home initiative, I believe, is part of this agenda. In addition to climate issues, insurer financial oversight and transparency remains a key priority for us. We have a number of accreditation bills that many of you have already passed. I think the 2 largest bills, I would say, from a financial regulatory standpoint that 30 and 31 states have already passed were the Holding Company Act revisions that included what we call a group capital calculation, and then also Holding Company Act amendments to a liquidity stress test framework. So neither are particularly interesting. Combined, they are very long, and when they come before you, they are very technical, and you'll hear us kind of talk about what they mean for accreditation purposes and what accreditation means for the department. I don't think I need to get into too much detail on what accreditation is, other than it's really the argument NCOIL made 16 years ago about why we don't need a federal charter, is because the accreditation program is so strong and where uniformity is required across the states on financial regulation of insurance companies, we have provided it through the accreditation program. So important legislation that you all, well, 20 of you will still see probably, if not this session, next, because I think they start to go into effect in 2026. A third priority is marketing of insurance products. We continue to look to kind of spread the word on how to address bad actors in our markets. Many of us have partnered with you in our respective states on fingerprinting reform, providing resources to the departments to help oversee our thousands of licensees at the state level. One area that I think we can probably collaborate more on is the NEIC continues to push Congress to restore state regulatory authority over Medicare Advantage marketing. We have no authority in that space today. All of our states here and our departments of aging will get complaints on an annual basis about what happens in the Medicare Advantage space. We can try to work with those complainants. We try to work with the federal government, but ultimately have very limited authority. So I think that's an area where we can work together and with Congress on to try to see if we can increase the authority that your state insurance departments have to crack down on those that seek to take advantage of insurance consumers. The fourth priority is our continued work in the race and insurance financial inclusion and protection gap space. This is a key priority, again, of President Mays, who focused a lot of his welcoming remarks on closing protection gaps. As one of our next agenda items, I'm going to talk about I co-chair the life work stream of our Special Committee on Race and Insurance, and I think we are working there on a policy statement that I'll talk about shortly that I think is another area where regulators and legislators can really work together to improve, in particular, the financial literacy of our graduating high school seniors, but I'll get into that. And finally, the last highlight that I think Commissioner Beard will talk about shortly is the use of AI by insurers in cyber risk. We have continued to try to balance innovation with consumer protection and privacy of consumer data, and you'll see us continue to work in that space throughout this year, both from an implementation standpoint of the bulletin that Commissioner Beard will talk about, and also further development of privacy legislation. So appreciate the opportunity again to be here and highlight some of the NAIC priorities. And I am remiss because I was also supposed to talk about a few other models that I didn't touch on the first time. So I will highlight those now. You have heard time and again about suitability and annuity transactions. It's one way that we counter the SEC and the Department of Labor when they try to bring fiduciary requirements to our agent producers. We countered that with a best interest standard in the annuity space. Many of you that have been around for 20 plus years remember that suitability started off as NAIC had a model suitability bill for 55 and over. That was amended probably in the early 2000s with the argument from legislators and regulators being, if suitability is good for people over 55, shouldn't it also be good for people under 55? The answer is yes. So we adapted the model. I think NCOIL at the time endorsed it, if I remember correctly. That was probably during my tenure at NCOIL. And then more recently, we have gone beyond just the suitability standard to develop a quote-unquote best interest standard. So not only does it have to be a suitable product for a consumer, but it also has to be in their best interest to pursue that policy over another policy or conflicting policy. The other model I would highlight for you, 23 states have adopted the Data Security Model Act, Pennsylvania being one, and that really kind of talks about requirements for insurance companies and the security preparations that they need within the companies. I think we've all seen data breaches become more and more common in the insurance space. We have a very significant one in Change Healthcare that I'm sure you all have heard about. And it continues to be a challenge for many of our hospital systems, many of our providers. The data security model was the NAIC answer a couple years ago to heightening standards for insurance companies and those that they do business with to ensure that they have mechanisms and procedures in place to protect consumer data. So with that, for the second time, I'll end and appreciate the opportunity.
Thank you,
Mr.
Commissioner.
Chairman, if I might just jump
Yes,
in
sir.
for a second, just to add an exclamation point to something that Commissioner Humphreys talked about, and that was the marketing of insurance products, just to bring to your attention. He did a great job presenting that, talking about Medicare Advantage, but an issue that we're all dealing with right now is the switching of individual health plans. You may have heard about or read about, but there's just a lot happening there. My personal opinion is that a lot of that is tied to this continual open enrollment for anyone at 150% of the FPL or below, so they can make a plan change at any point. We've got some, I'll just call them rogue agents out there moving folks without their permission, and people are ending up in plans that aren't that they didn't sign up for. We have folks in Oklahoma, I know, that are Native American who've been moved to plans and lost those sort of additional Native American benefits with the ACA. So just to bring that to your attention, that is a big issue happening right now that we are focused on at the NEIC.
Thank you, Commissioners, and we look forward to hearing more about that. I'm glad that you're focused on that. Okay, so I think we're going to transition at this point to a discussion update on the NAIC model bulletin on the use of artificial intelligence systems by insurers. So just for the benefit of my colleagues, after extensive discussions, the NAIC wrapped up last year by adopting a model bulletin on the use of artificial intelligence systems by insurers. You can view the bulletin in your binders starting on page 93 and also on the website. NCOIL worked with NAIC throughout the development of the bulletin. We submitted some comment letters noting some concerns that we had, chief among them being the importance of making sure that a bulletin would apply only to existing law rather than creating new law. And our concern dealt with the fact that NAIC chose not to deal with AI, a topic that is perhaps most important and relevant one facing not just the insurance industry but our society as a whole through a model bulletin rather than a model law or regulation, which I know you're going to clarify for us why you chose that path. We understand the perspective that AI is evolving rapidly, and that legislation may not be able to keep pace. And so we understand that this provides some agility, but as legislators, we're responsible for oversight, and we do need to be mindful of NAIC using model bulletins on controversial matters as the possibility of being a means around legislation. And we don't believe that that's what you're doing here. At least I don't believe that's what you're doing here, but we would be remiss if we didn't at least talk about it. So with that being said, can you share with us as an update what states have adopted the bulletin and what the next steps are with regards to the AI bulletin and any other model bulletins that may be in development that are related?
Thank you, Mr. President. So it has been about a year of work and development and working with stakeholders on developing the artificial intelligence model bulletin. And this concept was first discussed back in 2022 at the Innovation, Cybersecurity, and Technology H Committee. They announced that they were going to do some form of guidance that would take the form of a principles-based bulletin. And so the commissioners, we discussed what form or what vehicle we would want to use to address AI. And we thought the bulletin made the most sense because it is based on existing law. It is not trying to create new law. It's based on existing law in some states, some regs that deal with claim settlement practices, unfair discrimination laws, underwriting, market conduct, rates, and corporate governance laws. And so because of that, the bulletin is really a place to address things such as responsible governance, risk management policies and procedures, and also lays out the expectation of a risk management program to be developed by the insurers. It is there to remind insurers that decisions impacting consumers, making sure that those are supported by already existing law. So like I said, the state rate making laws, the regulations, the unfair claim settlement processes. I think drafts were exposed for public comment in July of 2023, and then in October of 2023, there was a new comment period to allow input from industry, consumers, and legislators. So once we had that feedback, significant edits were made to the bulletin at that time, and some of the edits addressed some of the NIST standards and updating the language on third-party contracting and testing and validation processes. So to answer your question, there are 8 states that have currently adopted the model bulletin, Alaska, Connecticut, Illinois, Nevada, New Hampshire, Rhode Island, Vermont, and Pennsylvania. So there's a state adoption map that is on the NEIC website that you can access to see, it'll be updated as states continue to adopt the bulletin. And then the NEIC is also developing a reference guide that will show how each state's bulletin compares to the original version that was adopted. So with that, I will conclude, and thank you for having us here today.
Thank you, Commissioner. I'm just curious, have you, as these states are adopting, and this is sort of rolling out now from conceptual to implementation phase, have there been any, issues, hiccups, pushbacks? Have there been any problems that you've seen as this is sort of played out, or is everything sort of smooth sailing?
So speaking personally, I have not seen anything just as a commissioner in my state and working with my colleagues, but I'm happy to take that back and report back if there are any hiccups. I'm not aware of any, but we can report back if I find out there were.
Yeah, I'm just wondering, Commissioner Humphreys, is it pretty straightforward, same thing?
Yeah, we adopted it after vetting it with the industry, so we put it out there. We received comments that largely tracked the comments that were received through the NEIC process. It was a spectrum from full support to, hey, you should look at these couple issues. In the end, for the purposes of uniformity and giving kind of a consensus approach to the companies, we deferred to largely the NEIC model, and just obviously we had to Pennsylvania-ize it, but no other issues since we issued it. Granted, that was a week and a half ago.
Okay, wonderful. Colleagues, any questions? Senator Feldhowski?
Thank you, Mr. Chairman. I guess when we get our 30-day materials, I was reading through this, and even when I look at your definitions, I understand the idea of what you're trying to do, and I applaud you, because when it comes to AI, nothing is easy. Nothing is easy when you're trying to do law or when you're trying to do definitions, but adverse consumer outcome. If I'm settling a claim and it doesn't go the way the consumer wants, that's an adverse consumer outcome. Or if I'm underwriting and the person has a low credit score and I deny that person coverage, that's an adverse consumer outcome. Can you elaborate a little bit on the broadness of that definition and how you arrived at that definition?
So I think that looking at the definition of adverse consumer outcome, I would want to take that back to the group that worked on the AI bulletin itself to make sure that any, comments about the development of that definition were accurate, and so we can certainly do that. As for the definition in the bulletin as it stands, as states are adopting it, I know, for example, Indiana, my department has not adopted the bulletin yet, and every department has the ability to change certain things in the bulletin to make it appropriate for their state. So I think something in my state that works really well when working with the legislature is I tend to make sure that the department tries to stay in its lane. And so they are the policymakers, I am the regulator, and I would not want to overstep that. I would probably look to existing state law, some of the state laws that I described earlier, and when implying that interpretation. So I think whatever the interpretation is of the bulletin's definitions, it kind of leans on whatever that state's laws are as they exist. But I'd be happy to, call out some of my colleagues who have adopted the bulletin to opine on that. But I think what we'd like to do is take that back to the working group that handled the bulletin.
Because if we're adopting a model and we're going to, suggest that take this back to our states, and NCOIL is going to put a stamp of approval on it, I think we'd like to know how those definitions were arrived on and what the intent was behind them. So thank you, I would appreciate that.
Members, any other questions? Okay. Commissioners, any other comments on that? I know that was kind of that's a very specific question, but.
It is. I'll just speak to what I believe the intent of that was unfair or unwarranted adverse outcomes as opposed to adverse outcomes in and of itself.
Okay. Appreciate that. Okay. So next on the agenda, we were hoping to visit with you about auto and home insurance affordability and availability. We've obviously been talking about this a lot already this morning. And, you know, I think the news media, obviously, consumer-driven news media, loves to talk about increases and decreases in rates. In an insurance-specific news outlet, but if it ends up being the New York Times or the Wall Street Journal, as it has been recently, at least that kind of gets my antenna up that maybe this isn't a localized problem, maybe it's not just California, maybe it's not just hailstorms in Texas, but maybe this is a nationwide thing. And I know we've spent some time talking about this already, and I know that y'all have been looking at this very carefully and are continuing to do so. So I was wondering if you could just give us your perspective, generally speaking, on kind of where you are as NAIC on what we're seeing in property and casualty affordability and availability, and kind of what your sort of game plan is moving forward, how you're addressing that, just to kind of help us see where you're going so we can figure out where we're going.
Mr. President, I think I'll start, and of course, any of my colleagues that want to jump in. I think probably maybe the best place to start with this is as it relates to the data call that the NAIC has just recently, in fact on March 8th, issued a property and casualty market intelligence data call. And most of you probably know the history of this, but the FIO came to us basically saying, we want this data and we want it to be from the property and casualty marketplace. We want it to be very granular. We want it to be zip code based. And though many states gather that kind of information, that level of detail information, some don't. And so we couldn't, as the NAIC, provide what they were after as quickly as they wanted it. They wanted it now. Basically, and so so it became this discussion, I guess, as to what they would do about it, and we really would. I'm speaking for myself, but I think you know that many of us anyway didn't want to see FIO get into this area. I imagine some of you feel similarly. And so we had some pretty heated discussions about that to say, what do we do to avoid having them get into this space? And so I think that started last summer, if I remember right, in Colorado Springs when we met as commissioners, and kind of finished up in end of November as we basically finally said, well, we played a little bit of chicken, I'm just going to say. And in the end, I think, I'd like to think that they blinked. They you know, we're able to say, we'll do the data call rather than have there be two, which would have been, I think, a disaster, would have been awful in a number of ways. So we'll do one. We didn't cave on everything that they wanted. It's got to be anonymized data for one. And we are hoping, we are pleading, we've put it in writing, that once we finish the data call, which by the way, that data is due, I believe it's June 6th, June 6th, it's due back. We will get to look at it first. We hope to, you know, basically make our summary and response first, and then we will give it to them. We certainly are pleading with them, asking them not to try to use it for political purposes. They probably will, but in my view. But what we are hoping, because again, it's a snapshot. It's a snapshot at a point in time that should not be used to inappropriately, unduly assume, or you know, that things are this because of this. So we that remains to be seen what they do with it. But the good news is we will have data about all the things you mentioned and more that we don't currently all have. And, of course, we looked at, together, they wanted to have 80% of the market basically captured through this data call on a premium basis. And so we found a way to do that. And we have a majority of the states, I don't know the exact number, that agreed to do this and either wanted the nationwide data or at least their states, like in my case, I'm interested to get the data for Utah. And so that's the long and short of it, I guess you'd say. I mean, it certainly will provide, we think, deeper insights into market concentrations, competitiveness, could identify, as Mike said earlier, coverage gaps, area, geographic gaps and so forth, and affordability of coverage issues. So we hope that it will provide some good, and we also are glad that at least for now, it keeps FIO out of the data gathering business. So from my colleagues, any examples that you've received so far and or pushback from insurers, for example, or just any experiences so far since March 8th or comments otherwise on this topic? Ladies and gentlemen, anything you'd add?
Sure.
Mike?
Yeah, and I wear another hat. I'm on FACI's advisory council. So I'm one of a couple commissioners and participated in the recent FIO meeting or the FACI meeting. And we talked about the data call, and I think there's broad support for a single data call. There's not going to be a redundant data call from FIO right now. I think to the commissioner's point, the messaging is going to be important. I mean, it goes back for 5 years of data, so can we make 200-year generalizations over 5 years of data? Probably not. But it puts many of our states in a good position to have more data on our own markets and look at where we may have pockets across the Commonwealth that my team will want to focus on in the future. I would say, separate from the data call, which I'm happy to talk about kind of FIO versus NAIC, et cetera. But separate from this, and I recognize that you all have a general session on costs. It's not just property, homeowners, it's also auto tomorrow. One of the issue areas that I get a number of questions on, and I did at my budget hearing this year, is auto insurance rates. And I suspect that as part of your conversation yesterday, or tomorrow, there will be some P&C trades that'll come and tell you part of the reason auto insurance rates are going up is because regulatory efficiencies, yada, yada, yada. We say that all the time. But I think what I would implore you to look at as you have that conversation is there needs to be a recognition of the substantial increase that inflation plays as part of this process. When we have seen double-digit increases in inflation, it is hard to keep an auto rate down. So yes, they're going to complain that sometimes some of our departments take longer than others to review a new proposed rate or a new proposed policy. But I think what we're trying to do when we get faced with these rate increases, that companies will come in and it'll be, I approved, I think, 2 GEICO rate increases in the mid-30s 2 years ago, and they were actuarially justified. I don't like approving a rate that's 35%, but these companies can actually show us, and we make them go back on a quarterly basis over the past 5 years to show us their claims runouts, to talk about where the projections look like on a going forward basis. So that we really, and our teams really do try to balance kind of the regulatory need for rate and the standards that we all apply to that rate, that the rate shouldn't be excessive, it shouldn't be inadequate, it shouldn't be unfairly discriminatory as we review those rates. So it's not just the quote-unquote regulatory inefficiencies that I would argue maybe are inflated from time to time. My team turns around a P&C rate increase less than 20 days on average. I think that's eminently reasonable. But there are these other cost factors that anybody that's bought a car, that has had to lease a car, can recognize that these costs are really significant now. They are growing in price. Parts are growing in price at significant rates, and that ultimately does have a significant cost on the automobile insurance. So regardless of whether, and we'll get this question from time to time also, you personally may not have had an auto accident over the last year, but as we all know, insurance is the pooling of risk. And as the costs to insure those overall risks increase at pretty substantial levels, you too will face a rate increase as the kind of system works its way through and accounts for the additional and new costs that are coming into the system. So just, I know you're going into that conversation tomorrow. Just wanted to give you some additional perspective, at least from Pennsylvania, on other cost drivers that I think you should consider as part of that conversation. So appreciate it.
Thank you, Mr. President. Any questions for the group?
Yeah, I think, and I probably should have led with this, but I'm just curious, from our other friends, commissioners from different states, we have a wide variety of the country represented here, and I mean, is it your consensus that you're all seeing the same kind of rate increases and availability challenges in your states that, that we might be seeing, that I might be seeing in Texas? I guess that's what I'm asking is it a fairly uniform problem? Because that's what I keep hearing, but we have the experts here.
I'll speak from Utah's perspective, yes, and the same things Mike just hit. Inflation, higher priced vehicles, more gadgets, technology, all those things add to that in terms of, as we're talking about auto and property, other property types of things. Again, you all read the news. I think, lots of factors lead to that. But one of the big things is inflation. Others?
Yeah, I think in Kansas, the macroeconomic factors that we can't control are very hard to justify, I guess, when you have a consumer calling and voicing their concern about their rates going up. But I do think, we all want these new gadgets on our cars, right? And a lot of them are safety. I mean, as a physician, I know they save lives and they do wonderful things, but they're very expensive to replace. I wanted to return just real quickly to the data call, and I don't know whether you said this or not, but over 80% of the premium written will be is included in that data call. And I think that's an important number. We're surveying both local companies and companies that do business across the state lines. And I think that's a good point to make. And I also think that might be why FIO was more agreeing to just have that one call. And I know from my insurers that are being surveyed, they don't want to answer these questions 50 times. It's time consuming for them, and it's just wouldn't be good for everybody to do that individually. Thank you.
Thank you, Commissioner. I know Representative Lehman had a question for you, so I'm gonna give him a chance to ask his question.
All right, thank you, Mr. President. Thank you for being here, the panel, and it's always great to see my insurance commissioner here. I want to go into something that we have talked about in the past, and I think what your data call is going to prove is what most of us in this room know, and that is inflation is killing us. What we've been replacing a roof for 4 or 5 years ago is almost doubled. Cars are more expensive to repair, et cetera. The other side of this coin is the availability. And so my question is, what's the data call going to show? Because what we see on the broker side is we're seeing a carrier get deeper and deeper into the technology, whether it's the telematics with cars, whether it's the drone technology, looking at roofs and things like that. And we're starting to see now this movement. I think there might have been an article here a week or so ago about, hey, we looked at your roof and your roof has used up its life. We're going to non-renew your insurance. So some of this technology is leading to an potential availability crisis. And I think when there's been some pushback to that, like, well, what if I go out and get an independent inspection, or what if I go out and get a second estimate? The answer is our decision is our decision. So, and again, this hard market, we're seeing the carrier. So I'm very sensitive to the affordability portion of this because everybody's taking 20, 30% rate increases, and an agent, we hear that every day. I'm more concerned, honestly, with the availability. Because I think it's some of this technology we're getting into, we're going to use that to basically get rid of anything that potentially is going to cause us a serious claim. And so we're going to have a crisis coming, I think.
Thanks for that question. Good to see you here too, and all the other legislators from Indiana and across the country. I think that in Indiana, so looking at rates, we specifically try to focus on Indiana experience. And I think that that is important to note because we have had some serious storms here now in the state. And so I think we are going to continue to see the effects of those storms, not only just immediately now, but for a prolonged period of time as we look at these rates. And so as we're considering rates, we also are working with the carriers to make sure that there are other factors, the other factors that are at play are not adversely impacted. And so availability is one of those things. So if we can work with the carrier during a rate filing to talk about, maybe the carrier wants to, stop doing business in a certain area or non-renew, we have been able to work with a couple carriers to work on some of the rate filing aspects of their requests to also talk about availability. And so I think it's important for the regulators to look at different areas that are impacted by rate filings, not just traditionally in the sense of the actual rate filing itself actuarially, but pulling in other areas of the department's expertise to look at the subject matter expertise of some of the policies that go into place behind some of these filings and what's available. And then I think also relaxing some regulatory requirements that are reasonable, I think can be helpful for ensuring that insurers are able to do business and, uphold their consumer promises. And so I'm all for consumer protection, but I also want to make sure that industry is able to remain financially solvent. And so with those things in mind, we look at, what parts of the states are being hit hardest and where are we seeing some of the availability issues and trying to go. I know that we did a town hall in, I want to say, southern Indiana a few weeks ago where there was a storm. And so we wanted to make sure that people were able to continue on their coverages. And if they were, going to be non-renewed, we put in a moratorium and then are saying that we will work with the carriers to try to help, with placements of products and encouraging them to work with their agents.
Great job, Representative. The only thing I would add to that is I think that the best thing that we can do from an availability perspective is that we, and when I say we, I mean we, this whole table here, ensure that we have a competitive free market happening in our states, and that we aren't putting up artificial hurdles that would take away the ability for the players in the market to fully underwrite and price accordingly. I wish he was here, so I am not taking a shot at him, but California, what we've seen play out there, and some of those artificial hurdles that were put in place, and then you see that availability disappearing and that competition disappearing. And so I believe that's the best thing we can do, all of us at this table, is ensuring that we aren't hindering that. In Oklahoma, we have over 100 companies licensed to write homeowners insurance in the state of Oklahoma. So ensuring that they have the ability to underwrite that and price that accordingly, it's math. That's, I think, what we can do to best address the availability issue.
And I think in Kansas, thank you to our legislators, because working with them, we've been able to reduce a lot of our fees on the industry. And we're trying to do our best to make it a better place to do business in. And I think you have to constantly look at things like that.
Yeah, and at the risk of being the wet blanket, at the same time, and I think it's something that Representative Lehman brings up, there are more third parties now as part of the process that I think the NAIC is grappling with now. We created a third-party working group that is these modelers that are coming in with these different scoring systems or different roof reviews. I looked at a couple pictures with some of my consumer teams. They were so high up, you couldn't see a darn thing on the roof. And then you're going to try to take a negative action against that individual, and they have very few rights or limited opportunity to appeal based on that one picture that's 1,000 feet up in the air. I mean, it's not a drone in this example of what I saw, but there are some with drones, and there are others that we've even seen that come in and they've developed tree scores. So I live in a wooded area, but what they're not doing is giving necessarily each individual an opportunity again to impact the score that they're being provided. So if I'm in a wooded area, but this system is not fully developed, it doesn't have every house in every neighborhood. So instead of giving me a score, it gives me the average of the area that I live in. So regardless of whether I've cut every tree down on my property, so there's not going to be a tree that falls on my roof, because they don't have a rating for my specific neighborhood, I get the average of that group in the wooded area. That's not fair. And what we have been looking at is when there is undetermined data, and you see it even more in the models where undetermined will come up as areas that we think are common. Like we will get scoring, proposed scores that will talk about the number of car doors that your vehicle has, and it's undetermined. And there will be a factor that applies to undetermined. Like the consumer in these instances has got to have some opportunity for recourse as part of that underwriting decision, because the average is not fair necessarily to all individuals. So I think that's the hard part with the balance and kind of the new innovative and much good from a lot of the innovative strategies that companies are employing, but there has to be a balance. And I guess to Commissioner Beard's point, the obvious, our most important consumer protection is the solvency of our industries. So, that is obviously at the top of our mind and how we approach it, but also want to make sure that as these new systems are being developed, there is a balance. There is an opportunity for consumers to understand what they're being rated on and the process they can have to potentially have input into how that rate is developed and applied to that specific individual in those cases. Thank you.
I think that Mike raised a point in my mind, which was the better tools that regulators have to be able to do their jobs. I think it's helpful. And so we're trying to innovate some of the resources we have to be able to keep up with industry or address some of these new technologies. So for example, we're doing at the NAIC, we're doing a SURF modernization project. SURF is the forum where rate filings and form filings get made with the states for review. So that should be an innovation that will be available to the states to use. We also have our P&C actuaries across the states have developed a working group, and they're very active, and they have a place where they can upload some of these models that they're seeing or some of these new innovations that companies are using. And so I think as there's more collaboration across the states with, fellow regulators and an increase in the resources that we have, I think that we'll continue to be able to address some of the concerns raised here today.
Awesome. That's very, very good, very robust. Let me just close this little portion of our dialogue by saying that it's obviously encouraging to us that NAIC was able to get to a resolution with FIO. I would point out that FIO's actions, along with the Department of Labor's fiduciary rule, along with the new proposed rules on short-term limited duration, it seems like the federal government is flexing its muscles again against McCarran-Ferguson, and I would just say as president, I would offer to you it might be worthwhile for our organizations to consider penning a joint letter of comment to our federal agencies, reminding them about the importance of the state-based system of insurance regulation. And, guys, we got this. We really don't need your help. So if y'all would like to work with us on that, we'd love to stand shoulder to shoulder with you on that, because
We'll take that back to the officers. Thank you. Yeah,
okay.
Great idea.
And then secondly, just to point out that we are very interested in your data call. We actually put on members on page 113 of your bulletin. We actually have a copy of the press release from NAIC. And I've asked for this to be a standing item of update at all of our future P&C committee meetings an update on the data call. So we really want to participate with you. We're excited about the work that you're doing. We're looking forward to the information and the data, as that may help us be better informed about, what we need to do as lawmakers to work with you and in making sure these markets are healthy and strong. I think we're in agreement that we want consumers to be protected, but obviously if there's no market, there's no concern about protection because there's no availability. So it's a balancing act. I wanted to briefly turn our discussion to the NAIC's efforts to support financial literacy in our high schools. As many of you know, April is National Financial Literacy Month. I think everybody here in this industry on the panel can appreciate the importance of folks actually having financial literacy, especially our younger generation. And so I wanted to give you a chance to comment on your work on that and to just also to thank you for prioritizing that and making that an important issue for NAIC.
Thank you, Mr. President. At the risk of not being invited back for talking too much, it is my turn again. So apologies in advance. I am the co-chair of the Life Work Stream of the Special Committee on Race and Insurance. And one of the issue areas that we are tackling this year is one that I've actually worked on for the last 10 years plus. When I was a regulator in Tennessee, Tennessee was one of the first states to require completion of a personal finance, financial literacy course as part of its high school curriculums. My Utah friend claims he was first, and we'll let them figure that out later. But it was an issue that is constantly one that we're challenged by. When we go out, when we meet with constituents, when we go into storm-ravaged towns following catastrophes, it's there's obviously an information and a knowledge gap often because insurance can be complicated. And what the idea behind this policy statement would be is really to put the NAIC on the map as being supportive of your efforts. That I think this is really growing across the states, just even over the last couple of years, in terms of requiring our graduating seniors to have completed a course in kind of personal finance. We believe that as part of a course in personal finance, there should be at least some teachings towards the basics of insurance, premiums, deductibles, maybe 101 overviews of the general lines of insurance that somebody coming out of high school will encounter. And it's one that I looked at from a special committee lens because there are so many different challenges with one-parent households, foster children, and others, and even in states where it's made optional. You tend not to see schools in lower income districts, in more diverse districts, that will stand up a financial literacy program. So what I think is incumbent on all of us to do is to work together. And I tried not to be prescriptive in the policy statement because I think each state is going to be a little different. I think insurance commissioners have a role to work with you and then to work with our departments of education who are responsible for developing what the curriculum should look like. Potentially, I mean, it's easy to put it as a policy statement. I know you'll hear from teacher groups and others sometimes about whether it's an unfunded mandate or not, and I think needing to be able to work together to help develop teacher training, to help them be able to teach these courses. But we issued this document for public comment at our last meeting. Comment deadline was April 1st. We received positive comments from the ACLI and some of the NAIC-funded consumers. I think we'll probably adopt it from the Life Work Stream, maybe at our next meeting later this month, if not, probably in May, and send it up to the full SCORI, because really it's not necessarily just a life insurance issue, but it's a conversation that I thought we had to have, and it needed to start somewhere. So our work stream took it on ourselves, Commissioner Fowler and I, in moving this forward. We heard from a resource at the Center for Financial Literacy at Champlain College. And this is where I'm the data comes from to suggest that it's grown so significantly. So today, for the graduating class of 2023, 7 states have requirements that their senior graduating class have taken a personal finance course before graduation. By the time that we roll into 2028, that is already going to be 25. So we are halfway there in a short period of time, and this has all happened over the last 5 years, really. And I think we can do more to help those remaining states build resources, build opportunity, and should work together with the insurance legislators around the table. It may not even always come through your committees. It may be economic matters committees, education committees, but I think it's such an important issue for young adults today that we need to start earlier. And I think the earlier we can start, the better. I have actually challenged my professionals in Pennsylvania. We have a junior achievement program where you even go in at lower levels in schools. I'm going to teach second grade personal finance over the course of 2 weeks later this month. But when I get the roster of individuals participating in personal finance, the insurance industry is woefully underrepresented. It's about 80 to 85% banking industry, maybe 5 to 10%, at least just in Pennsylvania, of individuals going in the classroom to talk about insurance. And that's really where we can get this started. I mean, I think though the game has changed substantially over the 30 years, I grew up playing that board game Life. And at the beginning of Life, you start buying auto insurance. You buy homeowners insurance. So when you land on one of those spots and your house catches on fire, you get paid. If you don't, then you end up losing and you owe the bank money. But even simple games like that, and just starting the students by understanding what the basics of insurance are, can go so much further. And I mean, any study is going to tell you, I mean, they get the basic introduction here that leads to better credit in the future, better understanding of their personal finances. That all ultimately bears itself out on the insurance side also. So I think to me, it's a no-brainer, and it's one that regulators and legislators can really work collectively on, in our 2 groups specifically, to encourage other states to follow suit and at least get this level basis of understanding for our future leaders in insurance. So thank you, Mr. President.
You're welcome. Yeah, I particularly liked what you said about, I think role-playing in games really is a very valuable teaching tool, instead of just lecturing to kids, but giving them the chance to actually experience a loss and the difference between a loss when you're insured and a difference between a loss when you're not insured. That's a pretty powerful example. So we appreciate your work on that. We are kind of running a little bit short on time, but I did want to arrive at I think one of probably the more pivotal discussions that we'll probably have here, and that is an update on the NAIC's framework for the regulation of insurer investments, including proposals relating to the SVO ratings discretion process. So for the benefit of my colleagues that are maybe new to this discussion, obviously this is an ongoing conversation that NAIC has been having. This is a conversation that we've been involved in. If you are new, I would ask you to look at page 104 in your binders. That's where you'll find the NAIC's proposed framework for the regulation of insurer investments. And within that framework, there is a specific 15-step process set forth that enables the SVO to review all filing exempt securities and determine whether the rating was reasonable or unreasonable from a regulatory standpoint. You can find that 15-step process on page 111 in your binders. Obviously, I know this is a process. We've been talking about this for quite a while. Certainly not the first conversation I've had with NAIC members on this issue, and I believe my predecessors as well. So I know we've been talking about it for a while, but we had flagged some potential issues to be addressed really into 3 buckets as the concerns that we raised to you. And one was the due process and appeal rights that someone that's under this review would have under this proposed document. The unintended consequences for the macroeconomy, and the fact that there may or may not be a poorly aligned or misguided financial incentive for the SVO itself in the event that it actually begins functioning as its own ratings agency and would essentially attempt to enter into the free market and compete against a regular NRSRO that's already out in the market space. And I know we have talked about this, but for the benefit of many of my colleagues that are hearing this conversation for the first time, I do want to say that I sincerely appreciate our ongoing dialogue and the fact that you have responded to our comments very positively, and many of the issues that we've raised have been taken into consideration and addressed. But I was just wondering if we could maybe begin the conversation with sort of a understanding of how this proposal has evolved over time from when it was first introduced and what the next steps might be as we go through this journey together.
Sure, thank you, Mr. President. And I know we don't have much time, and we do have this item on the agenda on a panel tomorrow afternoon with more time, so I can go into more detail at that point. But given the limited time, I'll just kind of touch briefly on the timeline, as you mentioned. And, you know, a couple things to mention. First, you know, we definitely intend to still rely on the credit rating provider ratings. There is no intention of having the SVO replace or compete with the CRPs. From kind of a process standpoint, there are a couple different specific work streams or initiatives that are underway with regard to kind of the CRP oversight or discretion. One, it's been in the works for a while, I forget, a year or so, under the Evaluation of Securities Task Force, where they're developing, that's the multi-step process that you referred to for discretion, if there is a need to potentially challenge a rating, and how that process would work. And I know the appeal issue is a big issue. I actually just spoke with the chair of the VOS task force yesterday, and she informed me that they are still working with industry, working with other stakeholders to try to come up with a workable solution that's efficient and effective. They recognize that what's been out there now in the latest exposure is not the most efficient, and they're still working to find a way to make that better. I know there was specifically to that proposal a recent comment period, exposure period that had ended. There were a number of comments that were received from various stakeholders. The members of the Valuation of Securities Task Force will be meeting, I believe, next month to really do a deep dive on you know, where we are in terms of that multi-step discretion process that's been exposed currently, what comments have been received, and what changes should be made before doing another exposure and providing another comment period. So it's very much an iterative process as we're working through this, very much trying to be transparent, listening to stakeholder feedback, and I would say, you know, it's great that NCOIL has been involved, and I would encourage continued involvement as we work through this process. So that's the kind of the current ongoing discretion, SVO rating discretion issue under VOS Task Force. Separately, but relatedly, under the investment framework, one of the action items is to hire an outside consultant to help the NAIC and to help regulators develop a due diligence and governance framework for how CRP ratings are used as NAIC designations. And at the Spring National Meeting last month, we received approval from the Executive Committee to move forward with developing an RFP to hire that consultant. And as part of that process, we've committed publicly, and we will, you know, continue to commit and be transparent about it, that we, through not just the process of developing the due diligence framework, but actually developing the RFP itself, we will be reaching out to and communicating to the CRPs to get their feedback, their input, other stakeholders as well. And then once that RFP is developed, we'll go back, get approval from our executive committee to actually issue that RFP, with the idea being we'll bring in this independent outside consultant to help develop this due diligence governance framework that will essentially give us more comfort, because the current model right now is a model where we have blind reliance on ratings from the credit rating providers that then track to NAIC designations. And I know we're at time, but we'll get into more of this tomorrow.
We're going to go a little past because we started late, so.
Okay.
Yeah, you have
Thank
time.
you, thank you. And part of the issue here with the concern about the rating accuracy and consistency is just kind of the broader, what's driving the broader discussion around updating the regulatory framework that we use for oversight of insurer investments, which is the increased complexity of the investment landscape that we've really seen since the great financial crisis. We've really seen a move towards more private assets, private credit, structured assets, and just in general more complex assets. And that's been a challenge that we hadn't seen previously with regard to how the CRP ratings track to the NAIC designations, which then we use for our capital requirements and accounting standards. So the intention is to continue to rely on the private CRP ratings, but to create this due diligence framework that will give us comfort that the ratings, the ratings that are coming out from the CRPs are consistent, are accurate, and the credit risk is essentially being analyzed and assessed accurately so that as it tracks to an NAIC designation, we as consumers of those ratings can feel comfortable with what that designation is and what that credit rating or what that credit risk assessment is.
Commissioner, appreciate that update, and I just want to say, again, thanks for your leadership on this, and also appreciate your willingness to be part of our panel tomorrow as we discuss this more in depth. Commissioner Schmidt?
Thank you.
Thank you, Mr. President. I just wanted to echo some things that Commissioner Hodig said and really express my appreciation to him because I do sit on his committee, and transparency is a big word for us, and I know that we're trying to be very transparent, and I think that Commissioner Hodig has done that, and also just inviting the interested parties to please stay engaged with us, because it won't be the last exposure that we have. I bet we go through a couple more, and it's a measured approach, and I really appreciate all of the interested parties that have responded to the previous exposures and know that they're going to probably keep coming. And so I think Commissioner Hodig's done a great job navigating a very, very difficult and complex item.
Thank you, Commissioner Schmidt. Well, I know we were going to talk about the accelerated underwriting, but if it's okay with you, I think we're going to bring this to a close because we are a little bit short on time. I did want to bring one small item to your attention and to just ask you if you've heard anything about it, because it came on our radar screen literally yesterday. And that is an effort at the federal level by the Federal Housing Finance Agency, Fannie Mae and Freddie Mac, to work on a program that would essentially waive title insurance requirements for certain mortgage loans. That kind of scares us in a way, because it sounds like a brand new encroachment on the state-based system of insurance regulation in a completely different area, and may involve these federal entities acting as unauthorized insurers. I was just wondering if y'all had heard of that, because I literally just found out about this yesterday.
We did, and I think even there was mention of it in the State of the Union address, but again, it's something that we are very concerned about from a federal preemption standpoint. We do have Eric Dunning, who is the Nebraska commissioner who chairs the Title Insurance Working Group. I've had conversations with him unrelated to this, but just in our Phoenix meeting, I chair the Native American Working Group, and we had a session on title insurance and some potential issues with the Native American tribal communities across the country. But not a lot to say about it, except that we too are concerned about it and are monitoring that. We'll continue to monitor it.
We look forward to working with you on that. Commissioner Lawrence?
Yeah, appreciate it. I just wanted to add, first, I didn't get an opportunity to speak, primarily because Commissioner Humphreys was talking so much, but I'm giving him a hard time in part because, like he referenced earlier, he was previously with the Tennessee department. I am the commissioner here in Tennessee, which I guess makes me something of the host. So I wanted to say thank you to all of y'all for being here. I know many of y'all are in session right now. That's the case in Tennessee as well, and it's we've reached that critical stage of session, and I'm sure y'all have every session as well, where things are contentious and the members are ready to get home. And so I don't think we have any members here right now because they've all gone home. But I really appreciate y'all being here. I hope everyone has a great time. I had a lot of jokes that I was going to make. I'll leave them all aside to just say that if anyone has any questions about Tennessee, Nashville, even though we are the Department of Commerce and Insurance, we'll also be the Department of Tourism and help anyone out with any questions you've got. And that's my joking part aside. And seriously, it is a concern about title insurance. That was maybe one of the more surprising inclusions in the State of the Union address, but something that certainly the NAIC is tracking. Thank you.
I appreciate that, Commissioner, and I would just add that I think a really good icebreaker at the NAIC meeting might be to identify the non-insurance related book of business that your department is tasked with overseeing in your state, because I know that probably would be a very long conversation. In Texas, it's amusement park rides and water slides and various things like that.
We have mixed martial arts at Commerce and Insurance. So. We can talk about boxing too.
I love it. Members, any other comments or any other issues? Senator Gossage?
Thank you. Thank you all for being here. Just really quickly, we were talking about some new issues that have come from the federal government. I was wondering if you all gave your public comments regarding short-term limited duration plans and what the federal administration is wanting to do or doing.
So for Indiana, we made a public comment on the proposed rule and also the final rule, and we oppose any encroachment onto our state's rights. And we have some innovative short-term limited duration plans in our state. We have a state law that was enacted that was, put some consumer protections in place, but made it so insurers could offer some innovative products. And so we are looking at how our current bulletin on some of the AHPs are affected and looking to see what we need to update in the state. And then we will continue to take the stance that the federal government's overreaching into the Department of Insurance's purview.
Yeah, we in Pennsylvania joined with a few other states in support of the reg. And I can share that letter with Tom or the team. Short-term plans have been a significant challenge in Pennsylvania. A lot of my consumer representatives' time is resolving consumer complaints where they thought they bought major medical insurance just to find out it was a packaged group of accepted benefit plans or limited benefit plans, and they had very limited coverage. They had pre-existing condition exclusions. They had caps and maxes that negatively impacted the consumer's opportunity to seek healthcare services that he or she needed. So we have had significant challenges with them. We've drafted our own legislation in Pennsylvania to try to regulate them further, but we were supportive of the suggested limitations on the duration of short-term plans. I know that makes me popular.
Thank you. I know we're running late, and I wanted to share this because there was a comment or a statement made earlier about the financial literacy and how it's mostly banking versus insurance. As a legislator, I take every opportunity and I seek opportunities to go into the classrooms. I have volunteered as a substitute teacher. Second grade, reciting the preamble to the Constitution, a 400-level class in the School of Environmental and Public Affairs at Indiana University. This one day I spent with the senior class at a high school on advanced social studies and took Schoolhouse Rock about making the law. We do a lot of top-down, legislators making policy, regulators doing, out of 5 classes, 3 of them came up with the idea of we need to know more about financial literacy. These are the students. So don't mistake a lack of interest. These kids are sponges and they want to know through that amendment process about homeowners insurance, credit card, student loans. They are dying for information. So I just want everyone to take that back, that kids want to know.
Appreciate that, Representative. Thank you. Commissioner Pike, last word? No?
I think we've said enough.
All right, all right. Well, no, I'm really grateful to all of you for being here, and again, look forward to continuing to work together. I will point out that what we're going to do now is take a quick 10-minute break, and we'll come back in this room for our general session discussion on rates and markets. And to my friends over here on the lawmakers side, please come over and say hi to our commissioners and make them feel welcome. And we're really grateful that they gave up their time to be here. I'll take a motion to adjourn. Second. All right, we're adjourned.